Hey guys, welcome back on the channel once again. So this is kind of a follow-up from the video I did yesterday about yield farming on these high-risk pools. Although Fartcoin is an established meme coin, I don't consider it to be all that much high risk right now, so I'm using a very tight range here. This is at around 5-6%, so let me check. Yeah, so it's a little bit above 6%. I did widen up the range a little bit after my last video because I saw the price going down a bit more than I was anticipating, so I didn't expect it to dip at around this 70 to 69 type of price. I was actually expecting this green candle to happen sooner, but anyways. And on the right side you can see here, this is the liquidity distribution for the pool, right? So in green you have the range, and then these bars are the liquidity distribution. If the price falls suddenly into this hollow spot, so you see here on the downside we have this much bigger spot, on the upper side there's this one. If suddenly the price drops here, it will take some time for this amount of liquidity to readjust. So you'll see that pretty much all the time the most amount of liquidity will be deposited around the current price, because that's what concentrated liquidity positions allow people to do, right? But if suddenly the price moves into this pocket, you can actually yield quite an interesting amount until liquidity readjusts. So there's automation protocols, but I don't think most people are using automation protocols. So this actually will exponentially increase your yield until the moment that other liquidity providers will readjust. This is a little kind of trick that I like to apply, and it works best if you are a very active liquidity provider, which again, it's essentially trading if you're being an active liquidity provider. Personally, I like to play with wider ranges and be more passive in that way. And when I'm doing like this sort of tests, I like to play with small amounts, take a little bit more risk because of that. So essentially that's what I wanted to share. Now I'm very tempted to increase this downside up to 71 and the upside potentially to 76, something like that, because I think we're on the next leg up, which will pretty much mimic what we saw here in the past. So something at around 73 to 76. I think that's the next leg up. Hopefully it will keep on chopping sideways. But right now the fact is that I'm about 14-15 hours since I adjusted my liquidity last time, and it already yielded around 1%. And that is a big change because in the previous days I've been yielding on average 2-3%, sometimes a bit more than 3% a day, because I was playing with a tighter range. But like I said in the beginning, I tried to protect myself in the case of these low turns once again. I wasn't expecting this, so I went a bit more conservative when establishing ranges. The way I was yielding around 3% a day was with a range at around 71 up to 75. Overall, I think 5%, probably below that. And right now, like I already touched upon, we're talking about 6-7%. So that range difference will definitely increase your yield. Now, the strategy I'm applying here, it's much more active once again, and I would be much more passive with a wider range. But since the balance is so small here, I want to make it work, and that's why I'm applying all these very tight ranges. Depends on what you're looking for, your risk appetite, of course. But yeah, just a small tip I wanted to share with you. Look for these hollow points. Look for the places where the liquidity isn't all that much deployed, and you can have an interesting boost on your yield until other liquidity providers adjust to the current price. Also, potentially, if you're looking at a chart which is chopping sideways like this has been for the past, let's call it 9-10 hours, you can increasingly just tighten up your range just to counter the fact that more liquidity will be deployed, more users will move their liquidity to that specific range. But again, I find it to be very interesting when you're having like these pockets, the price moves there suddenly, and then your yield gets an interesting boost. Okay guys, so I was editing the video and now I just checked the position, and this is what I meant. So you see the price just dipped into this hollow spot, lower liquidity, and you see the pending yield in a matter of half an hour, if that, went from 25 cents to 32. This is what I mean. And it will keep on yielding like this until more people provide liquidity into the range, readjust, which probably it will happen, depends on how the price moves. If it goes back into range a little bit higher, it will go back into this spot here, and again there will be more liquidity there, so there will be no necessity for people who are here to readjust. And you just saw here the pending yield to increase exponentially in a small amount of time. It's because of that. So let me go back here on portfolio. So the yield also went up 2%, and minutes ago it was at 4%. So the estimated yield was at around $1, now it's 53 cents, and that's because the price moved a tick up, and that tick determines the price to be just on the start of this tighter or higher liquidity deposit here. So if it moves a tick down and the distribution of the liquidity providers still remains here, meaning that in here in this hollow spot there will be less competition, I will see this pending yield increase substantially once again, and also the expected yield for the 24 hours to probably double. But again, this is something that is being adjusted over time. Don't expect it to be set in stone. Volatility in the crypto markets is the name of the game. What we want to do is maximize our exposition to these high yielding spots for as long as possible. Okay, so yeah, you see now it's definitely in this hollow spot, and if I go back here on portfolio, you see the yield just doubled to 4% today. So this is what I meant about those hollow spots. That's what I wanted to be the takeaway from this video. Now also let me point out, I had a comment in my last video. I asked you guys what were the pools that you were yield farming on and having good results. And I got a comment telling about Avo and also Useless. So Avo also is doing really well, 2.3% on average. Let's see Useless. So Useless with Sol also over 2% yield. So Useless paired with Sol also over 2% yield for the past day. The thing is that these memes are not nearly as established as Fartcoin. They've been running for a month, I believe, at least Avo. I've been eyeing out Avo and it has been doing really well. But for example, we see this one here. So yeah, this one would be much more risky entering now because we're at the top. It can potentially still go up, yeah, but at some point it will start dipping down, and you can see a massive crash in the position value if you deploy liquidity right now, and potentially if you don't want to lock in permanent loss, you'll have to wait. Who knows how long, and who knows if the token will bounce back again to this price range. If you have this happening to you, what you could do is that you can lower your downside up until it slightly meets the price, the current price. So let's say if it falls down to this floor here, you can have it 0.5 percentage point above the price. So if the price goes back up again, it starts generating yield, and you don't necessarily lock in permanent loss because you will generate yield as long as the price is within range. The downside is that your APR will be much more diluted because now you're having a massive range. Let's see, we're talking about potentially something like 54%, 70%. So you'll see a massive decrease in your yield potential if you use that tactic. And if that happens and you're like, let's say it here, then the price moves back into range once again, not only you will pick up all that volume, so it's going to be a very interesting yield, but then you will also see your position to be worth more and more, and eventually if the price bounces back up to the level that it is or it was when you entered the position, then the value of it will be virtually the same than when you opened it. Okay, so let me go back here and search once again for Avo, because Avo, I think it's at a much better entry point right now. Again, not financial advice, but let's check it out. So let me zoom out here. So yeah, this one has been running for around a month. So yeah, 29th of May, and now it's pretty much at the down low. So for the past, 3 days, it has been pretty much being in range if we would be having this sort of 20% range. So these ranges with these meme coins must be also wider because they're not as established. So they will be much more volatile. There's less liquidity in it. You see the TVL on this one, it's around 14K. So necessarily, if you go and get greedy, you can get wrecked, especially if the price goes down. But like I said, with this one, now the entry point is really low, so potentially it's a good point to get in. Worst case scenario, it crashes a little bit more. Best case scenario, it starts having a rally once again, and yeah, you can make quite an interesting yield out of it because there's still a lot of volume. I mean, the volume is twice the TVL, so there's still interest about people trading the token. Okay, but yeah, pay attention to what type of memes are you providing liquidity to. If they're very recent, go at least with a 20% type of range. For example, let me zoom out and see here. So let's let's say here, yeah, you see here, in order to catch all of this volume, we would have to set a range overall 80%. So even 20% with these ones would require you to be very active, make quick decisions, because if we go down to 20%, yeah, we would still pick up some action, but for the most part, from the 17th, let's go to of June until the 22nd, so we're talking about 5 days, most of these days would have been out of range. But I mean, if we enter, for example, in this point here in time, we're talking about 25-26% range to catch all of this volume, but then you see more leg ups, and if you see more leg ups, you will always be on profit. Then when it starts to go down, that's when probably most of the people panic because they're not looking to provide liquidity in the long term, and that's because these are very recent coins, okay? So they're memes, they might die out very fast. Take all of those things into consideration. Let me know in the comments if you have any questions, if you're new to this. I've been testing out with meme coins for over a year, always very conservative. I don't like to put all that much into them. And the matter of fact is that the ones that I do, they're still established meme coins, like the case of Fartcoin paired with Salt. So let's see how this one goes. I'm very tempted to just squeeze a little bit more here, the downside, because I'm anticipating the price to go up once again. And in the meanwhile, tighter ranges, more yield, but of course more risk once again. If you're a beginner, pay attention to these pockets. Don't go in with too much money. This is high risk. If you're looking to invest in crypto for real, I would definitely tell you buy and hold Bitcoin, okay? And leave this high risk stuff out of the way. If you enjoy trading, potentially yield farming is a good place to be because you can trade, you can earn fees while you do trade. So yeah, let me know what are your favorite pairs or the more profitable ones that you have been experiencing. I'm going to wrap this one up. Thank you for watching. Keep exploring crypto. Take care. I'll see you on the next one.